Hey folks, Ty here. How are you doing? Hope you're doing well. In today's video, we're going to be talking about investing. We're going to be going over investment methods for the beginner. Now, these are quite basic. When I say basic, you don't need to know fundamentals, you don't need to be an analyst, you don't need to understand diversification theory. It is pretty simple and it's aimed at the beginner investor. So if that's you, then you're going to love this video. This is going to be the one for you. Let's get straight into it. Now, I've been investing for over a decade now. I started paper trading when I was about 13 or 14 years old, and I have a variety of portfolios. In fact, you can see my low risk £100 a month portfolio up here somewhere in a different video. Now, before we get started, the first thing to do is like the like button, subscribe to the channel. I post every week without fail. I talk about investing, crypto, e-commerce, dropshipping, all that good stuff. So if that's what you're into, then do like and subscribe. It really helps me out. Now, before we go into method one, what I'm going to do here is I'm going to break down each method. I'm going to be looking at the indicators and telling you what makes a good stock under each method. This will make sense as I go along, and I'll obviously put something up on screen to make it a bit easier to follow. So method one is looking at the economy. Now, the economy will grow and shrink. That's a fact. We know there's going to be peaks and we know there's going to be troughs. That's just how it happens. This is commonly referred to as the economic cycle. When the economic cycle is at its peak, people are more confident, they are investing more, there's less uncertainty in the market. When it's at its bottom, people aren't investing as much, confidence gets shook, and there's a lot of uncertainty. People don't know what's going to happen, and people are more risk adverse during this situation. People tend to save more money and spend less during the bottom of an economic cycle, whereas vice versa, when the economy is doing really well, they are spending more money and they are saving less. With the UK and the US, we got hit by the pandemic, and then there was a surge in technology and kind of like work from home stocks at the end of 2020. And now currently summer 21, the market's seen a bit of a dip. And then especially with UK, with Brexit at the moment and supply chains taking a hit, there's a lot of uncertainty. And that means we're more towards the lower end of the economic cycle at the moment. So with this method, you basically have the cyclical companies and you have the defensive companies. Cyclical companies or cyclical shares will mirror the performance of the economy. They will mirror the performance of the economic cycle. So when economy is generally at its peak and doing well, these particular companies will also be doing well, and vice versa. It's simple as that. The economy does well, these kind of companies will do well. The economy does bad, these companies will do bad. That's what's known as a cyclical company. Example of cyclical industries are basically retail, property, car manufacturers, entertainment, and travel. So for example, taking travel, people tend to travel more. When the economy is doing well, people have more money, travel goes up. When the economy is doing bad, people have less money, they try to save more. Traveling abroad isn't necessarily top of their priority. So now we're going to go over the indicators of a good cyclical company. So I'll list these here. So the indicators are little to no debt. Now you can find this out just with a quick Google search. If you can find the latest financial statements, you can literally just Control F and type in the word debt and you will find it. Next indicator is how good or bad are they at reacting to downturns. So this one's not hard. The last downturn you can probably say was the pandemic. How did that company react to it? Did they adapt? Did they change? Or did they suffer? And that will give you a good idea of how well they'll react if the economy goes on a downturn again in the future. Now, the third indicator of a good cyclical company is to see how do they act when the company does well. Do they get cocky? Do they over-invest? Because if you've got a company that's over-invested during the good times, then when it gets bad, it's going to get really bad. So are they expanding slowly, or are they full on getting cocky with the investments? So do look into that, because that's a good indicator of how well that they're going to react if there is a downturn in the future. So 3 indicators are little debt, reacts quickly, and doesn't overexpand or doesn't get cocky with the investments. Now we've gone over cyclical shares, now we need to cover defensive shares. Now this is still all part of that method 1, looking into the economy. I will put timestamps below, so if you want to skip to another method, if this one doesn't tickle your fancy, that's absolutely fine. But let's look into defensive shares for now. Defensive shares are basically ones that tend not to suffer during the bad times. They do average, they do okay in the good times, and they do average or okay in the bad times. They're typically lower risk investments for people who are more risk adverse and have a low risk appetite. Personally, it is good to have some of these in your portfolio. If you're someone that wants completely no risk, then like I said before, do check out my other video where I go over my low risk strategy. If you're just wanting to balance out the risk, and if you've got a few risky investments, if you've got crypto in your portfolio as well, then adding a few of these could balance it out. A defensive company basically provides a product or service in good times and bad times. It's basically one where people are going to need the product or service no matter what the economy is going to be like. They act as a last line of defense in the portfolio because no, they're not necessarily recession proof, but they're that last line of defense. They're usually the last investments to get affected during a good or bad time. Examples of industries with defensive companies in, you've got supermarkets, you've got insurance companies, mainly ones which provide life insurance because everyone needs that, whether it's a good time in the economy or a bad time. And you've got healthcare and you've got household goods. Again, with healthcare and household goods, there's a theme here. You're going to need that no matter what, whether the economy's up, whether there's a risk of recession, you're going to need household goods and you're going to need healthcare. Now, there are indicators, like with the last one, there are indicators of a good defensive company, and here they are. Their profit and their earnings year on year are pretty much as expected. They're quite unsurprising. They're just as you would expect them to be. The other indicator is that the product or services that they're selling are necessities, as in they are always in demand. It's also a good pro if they're supplying different countries instead of just the one country. The third indicator is that they have a healthy dividend. Now, again, you can check this just by typing in Google, and it will tell you. You don't necessarily have to look into financial statements, like it will tell you year-on-year dividend. Dividend is basically a small amount of money that the company pays to shareholders as a reward for investing in them, and it's that extra bonus. Like, you're still going to be earning money from the growth of the share, but on top of that, the company does well, you'll also get a dividend. Traditionally, companies which issued out dividends meant they were confident in the company. It meant the company was doing well because the owners were confident in issuing that dividend. They're basically like, we are doing well, let's give something back. So that's the method. Within the economic method, so looking at the economy, you do have cyclical shares and you have defensive shares. Now, how do I rate this method? It does seem fairly straightforward. It is easy to conduct. Most of this, you don't need any prior knowledge. It's also really easy to do some research just using Google. It does take time to find companies in each sector or industry if you're not already familiar with that. And it also takes time looking at how they reacted during the last economic downturn. Obviously, with the pandemic just being a year ago, it's not too difficult. But if you're looking at downturns from more than a year ago, it's going to be difficult to find how they reacted. Like, you're going to need to know specifically how did that company react to this specific situation and how they reacted to situations since, because this is going to be an indicator on how they're going to react in the future and how stable they are as an investment. This method works particularly well for those who are interested in current affairs, who keep up with the business news, who keep up with just the general news, either around the world or in their country, who have an interest in businesses and industries. They might work in an industry themselves and have an interest in it, and then you'll find, like, in your news feeds, these are the ones which are popping up. Then that might be an indicator that that's the industry for you to look at. because you're so up to date with it. You have a lot of knowledge about it. Now, a good portfolio tip, if you're going to be including cyclical and defensive companies in your portfolio, then just think about how you're balancing it out, because cyclical companies, like I said, will go up and down. Defensive companies are more for the risk adverse. So depending on your attitude to risk, if you want a complete low risk portfolio, then you might want to balance it out with, you might want to put more defensive companies in rather than cyclical. If you're somebody who has a lot of faith in the economy growing and you're quite risk preferred, then you might not want to have as many defensive companies. That might not bother you. So just do take that into account when you're building your portfolio with cyclical and defensive companies. Method 2 is using long-term themes. Now, this method is kind of building on the economic method, but rather than looking at the economy as a cycle, we're looking at the economy as a whole. We're looking at the world as a whole. We're basically looking at what the world is going to be like in 10, 20 years' time. We're asking ourselves, what are the major problems going to be in, let's say, 15, 20 years' time, and which industry is going to be combating this? Now, there is an element of guesswork here. It's not certain, and like any situation, shares can rise and fall. Buying into a big theme can yield massive rewards, but again, sometimes it can fall flat. So do bear that in mind if this is the method that you're going to go down. Like I said before, there are timestamps. If you want to skip this one, that's absolutely fine. If not, let's crack into it. So let's look at 3 big themes that you can undertake this method with. So the first big theme is technology. How will businesses adapt to future needs? What are the future problems going to be? At the moment, you've got all the technology manufacturers doing so well. You've got Apple, Microsoft, Tesla, everything like that, who are taking advantage of technology. But in 10, 20 years' time, what are the issues that are going to be related to that? Is cybersecurity going to be replacing the big technology companies because it's going to be in so much demand? Is wearable technology going to be the forefront? Is that going to replace things like mobile phones? Is everything going to be wearable? It's things like that you need to think about when talking about these big themes, especially with technology. So for example, like I just said with cybersecurity, if everything's going to be more reliant on technology in 15, 20 years time, then cybersecurity is going to be a really big thing. So you're going to want to be looking at the companies potentially that could be leading that sector in the future. The second big theme is climate change. Now, will electric cars be the norm? Will the growth of hydro, solar and wind continue? Will plant-based food be more in demand? Will they be the leading food companies? We don't know, and that's what you're going with. This is why I said it contains an element of guesswork, because it's depending on your opinion, and it depends on what you're finding whilst you're researching. Like if you're thinking, oh yeah, electric cars are going to be, it's just going to be electric cars in 10, 20 years time, then start getting into those electric companies. Like just, I'm not saying go all in on Tesla, but look at the other ones that could be competing with Tesla in 10, 20 years time. What are going to be the main car manufacturers in 10, 20 years time? Is it going to be NIO? Are they going to be coming into the UK and the US and taking over a bit of that market share from Tesla? Like, we don't know. That's what I mean about the guesswork, but at the same time, you've got a good basis to stand on. There's a lot of research out there, and there's a lot of information for you to make an educated guess, basically. Now, the third big theme that we're going to be talking about is e-commerce. E-commerce is just thriving over the last couple of years. It got a big boost from the pandemic. Everything's moving online. You've got high streets struggling, and you've got online retail thriving. So in, let's say, 5, 10 years time, what's the e-commerce space going to look like? In 20 years time, what's the retail space going to look like? Is it all going to be online? And how can you be a part of that? Now, you don't even necessarily have to go for e-commerce companies with this. You can look at the bigger picture and things like who are going to be the payment providers for online companies? Is PayPal still going to be the biggest go-to online provider? Because they've seen some serious issues with e-commerce entrepreneurs where they hold their money for months on end. Like, is there going to be a new competitor in the space? Can you see this competitor before it becomes a big thing? Is it something that you can detect yourself? It's things like that that you need to think about. Like with e-commerce, you don't even necessarily be looking into your country. You can just think, what's popular in my country that emerging markets and are going to be doing themselves? Like, is there going to be an alternative to Amazon? Is there going to be an alternative to things like YouTube? AliExpress and Alibaba seem to be the main go-to for dropshipping and e-commerce, and that's based in China. Like, is there going to be a US version? Is there going to be a UK version? The European version? Like, things like that is where you'll start seeing trends. For example, Neo was seen as, it's literally described as on the free trade app as the Chinese Tesla, and we all know what happened with Neo. Things like the Chinese version of YouTube and Google search are also doing really well. They do so well because they're providing that service to a whole other market that they know that's working, because another big company is already doing it and people love it. So why not introduce it to another market? Like, those kind of companies are pretty easy to identify and they do extremely well. So do keep that in mind whilst you're doing your research. So your portfolio tips with this is that, like I said, they do contain an element of guesswork, more so than the economy method, looking into the economy. So depending on your risk appetite, you might want to include more of these kind of stocks, you might want to include less of these kind of stocks. It's entirely up to you and entirely up to your attitude to risk. You can always adjust if your risk appetite adjusts in the future. Let's say you want to start saving for a family or a house and you need to adjust your risk accordingly, then you can just lower these kind of shares, sell your holdings if it's a good time in the market to do so, and then put them into more safer investments. That's absolutely fine. Method number 3. Now this one is absolutely absurd and you're probably going to laugh at me for suggesting this, but it is just investing in brands you love. Some of the top investors invest in brands that they truly can get behind and that they love and that they're part of their everyday life. Like, you don't need to be an investment analyst to do this. Anyone can do it, and that's what I love about this method. When you walk into a store, think about the last time you walked into a shop. You are taking in all this information, like you are observing what is selling, what isn't selling. Maybe you see an empty shelf, maybe you see the sale racks. Like, you're taking in this valuable information and doing nothing with it. And this is the kind of information that can help you with this method to make an informed decision. So for this one, you want to be considering 3 things. And this is quite odd to think about, so I'm going to propose these as questions. So the first thing to consider with this, and I'm going to propose it like a question, is if you were just going about your day as you were, and one brand that you use, one product that you use, just suddenly became non-existent, just suddenly disappeared, what product or brand would you be most upset about? For me, it would have to be Google. Google is the search engine that I use dozens of times a day, hundreds of times a day sometimes. And they obviously have YouTube as well, which I spend hours on. I post on YouTube, so that's the one that would affect me the most. So just think about that. Like, what brand, if it just suddenly disappeared from your life, would you be most upset about, or would you be most hindered by? And then ask yourself, why don't I invest in that? If it's such a big part of my life and I support it, then why don't I invest in that company? I invest in Google, and it's because, not just because I use them every day, but I support the company and I want to benefit from its growth. Simple as that. Now, the second one that I'm going to propose is, have you recently come across a new product or a new service and you think this is so much better than the one that I was using before, the brand that I was using before? I've been converted, I'm definitely using this one. If so, why don't you invest in that company? If you've thought that, then the chances are multiple other people have thought that too. So why don't you invest in that company? It's things like that which this method thrives on. So there you have it. I've just gone over 3 ways to pick shares. Now, like I said, this is like complete beginner's course. You don't need to have a Bloomberg terminal. You don't need to be an investment analyst. This is completely anyone can do. So if you are looking for something to look more into the fundamentals and the ratios and financial statements, then do let me know and maybe I'll launch a part 2. One last thing, guys, just remember this isn't financial advice. At the end of the day, I'm just a guy on YouTube, so do take everything with a pinch of salt. Always do your own research. If you've got any questions, do hit them below. Don't forget to like, subscribe, and I'll see you in the next one. Thanks for watching.